Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The last 12 months have been a pretty volatile time for equity investors. Today, I wanted to look at how a fund manager picks international stocks that can weather a storm. Remember, this information is general in nature and you should seek professional advice before making investment decisions. Stephen Arnold is the founder and chief investment officer at Aoris Investment Management, a supporter of this podcast. Stephen, welcome to Fear and Greed.
Thanks for having me, Sean.
So where are we up to, particularly on Wall Street, given the earnings season it's wrapped up now, but it kind of, things aren't as bad as some people predicted.
Oh, it's a good observation. There's been no corporate disasters. You haven't had the bankruptcies or sort of massive downgrades. So I think it's a complex picture. On the one hand, you've got an employment picture that in most places in the world, including Australia and the US, is pretty healthy. The unemployment rate in the US is back around where it was in 2019, and the number of jobs being created is at historically high levels. On the other hand, there's plenty of challenges associated with inflation. So a complex picture, but most businesses are still progressing, and it's in most regards surpassed most people's expectations.
Now, I want to go through some of the companies that you do invest in, but before we get to that, what is it that you're looking at? How do you think about investing in overseas stocks?
Well, Sean, we look for businesses that become more valuable over time, and we want businesses that are competitively winning, that grow faster than their peers, businesses that are consistently profitable, so all-weather rather than fair-weather businesses, and businesses that are proved to be very durable. They've been around a long time. And I think if you think about those three aspects, resilient, durable, and competitively winning, and put them together along with price, then I think you've got a good combination for the sort of businesses that you want to be owning in today's environment.
Okay, and diversification matters?
Well, we own just 15 businesses, which sounds concentrated, but we also like businesses that are by themselves quite internally diversified. We can touch on that as we go through, but we shy away from very narrow businesses, perhaps biotechnology businesses that do one thing in one place. We like businesses that do multiple things, serve markets that straddle the breadth of the economy, and that provides a lot of that sort of resilience and durability I spoke of.
Now, one of my favourite companies is definitely diversified. You'd almost call it a conglomerate, I reckon. LVMH. You like LVMH?
Yeah, look, it's have all those attributes. Some of the brands that they have within the LVMH stable have been around for more than 100 years. It's a business that proves surprisingly profitable throughout the pandemic. And through the pandemic, it's absolutely proved to be competitively winning. In fact, just to wrap some numbers around it, the sales in the first half of the year, despite the lockdowns in China, grew by 19%. 19%, a very impressive number. So there's a lot of the fine qualities of the business around some of the world's most desirable brands that have contributed to that. But you can see that those attributes that we're looking for, very resilient in times of stress and being able to grow significantly faster than the broader luxury market.
With the luxury market, how important is China? Because you mentioned that up front. Longer term, I'm sure it's critically important, but what about the medium term?
Yeah, look, I think as you said, it's a business that serves consumers in many parts of the world across many brands and many price points. And while China might be around a third of their sales, that hasn't gone away. And as countries like Australia start reopening, the tourism will provide a big boost. People tend to buy these luxury products when they're traveling and they like to treat themselves. And while China's been a bit suppressed with lockdowns in the first half of the year, demand in places like Europe and particularly North America has been very, very strong. So that it goes back to those attributes of diversification, many brands, many price points, many consumer types and geographies, but it's all within a business that's very, very well run, and it's proven to be so over many, many years, going back to those characteristics of durability that we spoke of.
Stay with me, Stephen. We'll be back in a minute. My guest this morning is Stephen Arnold, Chief Investment Officer at Aoris Investment Management. Okay, what about Costco, the retailer? Why do you like Costco?
Oh, look, Costco's such a wonderful business. Some of the attributes, it's an unusual business. You have to pay an annual fee of around 100 Australian dollars for the right to shop there. But when you do, people prove to be very loyal. And when they walk through those doors, having paid a membership fee, they expect good value. Now, It's been a competitively winning business right through the pandemic, including the first half of this year. And you may have heard of some retailers in America with particular difficulties around too much inventory, which they then have to mark down, which really hurts their profitability. Retailers that might be selling less because consumers are just pulling their horns in a bit. But through all that, Costco's grown very strongly. In fact, about sort of 15 to 20% consistently through the first half of this year at profit margins that are in line or above last year. It's a retail concept that's been resonant in pretty much every city in the world that it's been taken to. I think they've got about a dozen shops in Australia, or warehouses as they call them, that have worked very, very well. I think people just love that combination of quality and value. And through the pandemic and into the first half of this year, the business has grown at a really, really, really strong rate.
As far away from Costco as you can get, I reckon, is Accenture, which is another one, the consulting group, which really has been done, I mean, from afar, it looks like it's done really well in recent years, Accenture.
Yeah, it has. Look, I think another way to think about the sort of attributes that we're looking for in a portfolio of international businesses that will serve us well through a stress period is relevance. We like businesses that are more relevant to more consumers, more users, more customers than they were a year ago. And Accenture really embodies that. They help the world's largest organizations deal with change, and there's no shortage of change. It might be helping very large banks to protect their data. It might be helping retailers to create strong e-commerce propositions. It might be helping insurance companies or government departments process transactions more efficiently. And Accenture is more and more relevant to more and more people than they were a year ago. And the first half of this year, their revenue grew at 20% in an economy that, of course, is slowing down. Business confidence is not what it was a year or so ago. So that growth rate really speaks to them being more relevant to more of these large organizations. And despite what we hear about wage inflation and cost pressure, their profit margins were higher than they were a year ago.
Wow.
And lastly, it's a very diversified business. It serves customers, large organizations from pretty much every part of the economy and pretty much every economy in the world. So there's a lot of kind of breadth and resilience and robustness that come with that diversification.
You talk about relevance. A company which I am continually surprised by and admire is Nike, because it's as relevant to my 13-year-old daughter as it is to me. And I think that is quite an achievement.
Yeah, look, they, much like my two teenage sons, there's a lot of Nike product. If you open up their clothing drawers, and they really connect and love the brand. They love the sports that Nike gets behind. Look, it's a business that kind of likes their athletes. It's a very competitive business. They just want to grow. They want to win. They want to create more customers. They want to create more connections with big sporting events. Even during the last year where there's been challenges of getting product to market, shipping costs, parts of the world, including Australia and China, that have been locked down. What we like about the way the business has been run is the foot's always on the accelerator. Yep. They just want to continue to create great product, create great messaging and connections with consumers, and invest behind their stores and the customer experience, and make the business long-term healthy, rather than trying to manage for optimize a particular quarter, which might be pulling back on those investments, rather than having the foot to the floor and making the best long-term great wealth-creating business.
I mean, there are others that, L'Oreal, Microsoft, Tractor Supply Company. I remember you talking about them last time you were on, what a good business that is. When you own all these stocks, is it something, do you trade them regularly, or is it more a process of getting great stocks and sticking with them?
Oh, look, Sean, it's much more the latter. We want to let the companies do the hard work for us in growing profitably and becoming more valuable. We're participants in that wealth creation. On the other hand, prices change, opportunities change. And so we would expect about 4 of those 15 businesses that we own to be replaced every year. We'd like to own businesses for 4 or 5 years on average. Some are longer, some are shorter. But it means by replacing only 4 a year, we can put a lot of thought behind each portfolio change that we make. We can know the businesses very, very well, which I think becomes hard if you're a fund that owns 40, 50, 60, 80 businesses. How well do you really know them? For us, we like to know them well and make relatively few but very considered decisions.
How do you bring your ESG principles into it? Because I know that you fundamentally follow an ESG framework. So there's a bunch of companies and sectors that you won't invest in. Some are fairly obvious, mining companies, energy companies, gaming companies, tobacco companies. Others less obvious to many of us, banks, insurers. Is that a hard and fast rule, or does it evolve over time? How do you think about ESG in your portfolio?
Oh, Sean, great questions. Look, we think about it a lot, and I think to businesses as well as to investors, it matters more and more. I think we're speaking about being long-term investors, and I think the longer term you are as an investor, the more it matters, because it affects how a business connects with its customers, its reputation in the marketplace, which is more and more transparent today in a way that it wasn't the case 10 years ago. So we have these hard exclusions we won't own: gaming companies, tobacco companies, utilities, energy, mining companies, banks. But then once we've moved past those exclusions, we look very hard at how businesses behave. And one thing I'd really highlight is the choices that businesses have made during the pandemic have mattered more than we would have anticipated. We hear time and time again from companies that we own how good long-term, sometimes costly decisions to support their customers, to support their employees, has led to improved reputations, improved goodwill with their customers and employees in ways that are long-term beneficial for their businesses. So it matters more and more. Sometimes those decisions don't show up in an ESG scorecard, if you like, but we pay attention to them. And through the pandemic, it's mattered a great deal.
Fantastic. Stephen, thank you very much for talking to Fear and Greed.
Thank you, Sean.
That was Stephen Arnold, Chief Investment Officer at Aoris Investment Management and a supporter of this podcast. This is a Fear and Greed Daily interview. Remember, this information is general in nature and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.